Canberra for Canada's Mortgage Minute on Tuesday, March the 12th. I ran across an interesting article recently and I thought I'd share it with you. And it was about the Canada Pension Plan and whether you should take it early or wait till later. The story had an example of a couple. They were from Winston and Sheila Billard, and they were from Nova Scotia. Winston is 72 and he's a retired teacher who lives in Cape Breton. And he had paid into the plan for about 37 years. And he started drawing his pension when he was 63, and last year was getting about $8.83 a month. His wife Sheila was a nurse, and she made contributions for about 44 years. She worked a long time, and into her 60s she was still working part-time, so she delayed taking CPP. Last year when she was 66, she got diagnosed with an aggressive form of cancer, and had only just recently started taking payments, and at the time when she passed away, which was only a few months later, was getting about $1,053 a month, and she only got a couple of payments. Now, basically, in these sorts of situations, there's enough stress in one's life, but Winston, when he went to apply for survivor benefits, got a real eye-opener and a couple of other major shocks. Most pension plans have a default survivor benefit, which are the private plans, and they're often at 60% of what can be of which can be adjusted upwards. And if one spouse dies, the other gets a reduced but a substantial monthly payments to maintain their lifestyle. But in the case of CPP, that's not what happens. Even if both spouses have contributed all their lives, as in the case of these fine folks, the survivor is entitled only to one maximum benefit. And the rationale that the Canadian government or the pension plan applies to this is that nobody should be able to get more than the maximum that one person would have received who worked all their life. So Harry Winston, had he not worked, would have been entitled to 60% of his wife's benefit, but because he worked, he wasn't entitled to that anymore. And when he finally did get the survivor benefit for his wife, it was $22.75 more a month. That was it. And that brought him up to the maximum. So now he's getting about $933 a month, including the $22.75, versus the maximum that's allowable, which is $1,012. Now, of course, he doesn't certainly feel this is fair, but according to the federal government and the folks that head up this, they figure that the rationale for establishing a limit basically reflects the principle that no one person should receive a combination of pensions that is greater than the amount payable to an individual who made the maximum contributions to the plan throughout his or her working life. So basically what they're saying is, look, you should get no more than the contributions the one person made. There should be no double dipping allowed. And that the Canada Pension Plan works on what's called pooled risk. So they know that some folks are going to pass early, some are going to live later, and the benefits that one doesn't receive go to another, and it keeps the fund running and running. So, but in the case of these folks, it certainly wouldn't seem fair that somebody who paid all their lives into it got very little benefit from it, and now that they've got a survivor or a spouse left, they're not getting much of it either. So this would make one think that maybe the advantage would be to take the money early, but not so according to the government. They say that if you delay CPP until you're 70 years old, you will receive roughly double the amount that you would have received at age 60, and about 42% more than what you would have at age 65. And Statistics Canada says that an average, basically a 65-year-old Canadian can expect to live on average another 20 years or so. So by waiting, you would think that you would get that bigger payment that is inflation protected for a long time. Of course, the unknown in all of this is how long we're going to be around. So if you come to this bridge, you really got to make a decision. And the bottom line this really speaks to is the fact that you cannot rely on CPP alone, and you've got to have another contingency plan going into retirement. That's it's a definite must, and there's no reason why one shouldn't, because quite frankly, $1,000 or under $1,000 a month is nothing to live on, especially in this part of the world. The other thing that one can look at or draw upon if they don't have a lot of savings, if you do have a house paid off, is to look at the possibility of a reverse mortgage to get cash flow out that way. And those are certainly a product that can be very useful for somebody who's a pensioner, retired, and on limited income, yet has this big asset and all of this equity tied up in it. Anyway, I thought I'd share that story. It was an interesting story and quite an eye-opener, because you would think, quite honestly, they would both, both pensions would come to one person, but the sheer amount that it doesn't, and the size of the benefit the other person gets is paltry at best. Anyways, another reason why you've got to do financial planning You got to be savvy about these things, and you've got to think about your own retirement, and we cannot rely upon the government to fund it for us. Enjoy the rest of your day. I look forward to talking to you tomorrow, and as always, if you need anything mortgage-wise, don't hesitate to let us know.